The day Victoria Ashbourne mocked the worn lapels of Nolan Pierce's suit before her entire executive team, she was certain of one thing. A single father who left the office each evening to care for his daughter could never threaten a billion-dollar empire. She called him a glorified invoice checker, too timid to understand real business. Nolan did not argue. He placed a folder on the table and asked one question that drained every drop of color from Barrett Kingsley's face. Should he overlook $40 million, or explain it to a federal agency? The room went still. Victoria smiled, right up until his audit cracked open a web of phantom invoices stamped with her own signature. Subscribe now and stay until the very end. Watch the most arrogant people in the room dismantle their own empire, one false signature at a time. 3 weeks before that boardroom confrontation, Nolan Pierce arrived at Ashbourne Industrial Group headquarters while the Chicago sky was still dark at its edges, pulling his aging sedan into the employee lot well before the executive valet began their morning rotations. He carried a dented lunchbox and a briefcase with a broken clasp, moving through the lobby with the kind of unhurried certainty that goes entirely unnoticed in a building full of people performing urgency. The headquarters of Ashbourne Industrial Group occupied 11 floors of a tower in the West Loop, its glass facade etched with the family name in letters 3 feet tall, a monument to 3 generations of wealth that Victoria Ashbourne had inherited and was now aggressively expanding through the planned public offering of a subsidiary. Nolan's desk sat in the tax accounting division on the 7th floor, where natural light arrived second-hand through a line of interior windows filtered through the finance department's glass partition walls. He had held his position there for 4 years, long enough to know every quirk in the company's filing systems, and short enough that the executive floor still thought of him as temporary furniture. That morning, his supervisor had forwarded a directive from the CFO's office. Nolan was to review the consolidated tax filing before the company's quarterly earnings announcement, a task assigned on a Tuesday and expected back by Friday. The return window was tighter than standard review protocol allowed, and Nolan had learned over years of quiet observation that rushed timelines on tax documents were rarely accidental. He spread the preliminary filings across his second monitor and began at the beginning, not the summary page executives always pointed to, but the raw vendor ledgers and subsidiary payment logs that formed the invisible foundation of every number that eventually surfaced in a shareholder report. His coffee went cold beside the keyboard, the overhead lights hummed, and around him the floor filled gradually with colleagues who offered small nods and returned to their own screens. Nobody stopping to ask what the man in the faded charcoal suit was working on so quietly. Miles Sterling passed the accounting bullpen at 9:30, visible through the glass as he moved toward a breakfast meeting with a group of bankers, and he paused long enough to gesture at a colleague, point at Nolan's jacket, and say something that made the small cluster of managers around him laugh before they disappeared toward the elevator bank. Nolan glanced up, registered the laughter with the same expression he used for elevator music, and returned to the ledger on his screen. He had found something by 10 that morning, a vendor called Northbridge Advisory Services, appearing across 3 separate invoices totaling over $2 million in consulting fees, claimed as deductible business expenses. The invoices were formatted cleanly, the approval signatures legitimate, and the payment dates spread far enough apart to avoid triggering any automated threshold alerts. What they did not have was a phone number connected to a real office, a website that had been active within the last 2 years, or a physical address corresponding to any commercial property in Illinois. What they did have was an incorporation address, a suite number on a post office box street in Wilmington, Delaware, that Nolan recognized because he had seen it 3 lines earlier, listed as the registration address of a separate vendor called Crestline Technical Partners. He pulled up a third entity, Meridian Facility Solutions, and found the same Wilmington address listed as its principal office. 3 companies, 3 separate vendor codes, 1 address. He opened a fresh spreadsheet and began writing down transaction reference numbers. That evening, Nolan drove home through the familiar grid of streets and arrived at the apartment 20 minutes before Sadie finished her homework. She met him in the kitchen, 16 years old, and still carrying the habit from childhood of waiting until her father had set down his briefcase before asking him anything, as if she understood that men who spent their days carrying weight needed a moment to put it down first. They ate together at the kitchen table. A routine they had maintained since her mother's illness made the dinner hour sacred, a proof of presence that neither of them had ever been willing to surrender to a company calendar. Sadie said he looked distracted, and Nolan told her he had found a number that did not belong where it had been placed, the kind of understatement that meant more to him than it could to a 16-year-old who had not yet learned to read the language of financial irregularity. After she had gone to bed, Nolan sat at the kitchen table and opened the worn cardboard box he kept on the top shelf of the hallway closet, the one that held his professional certifications and a business card from a firm he had left a decade ago, and the card read Forensic Accounting Lead, and the firm's name was one that had appeared in court documents twice in the years since he had departed it. He sat with the card in his hands for a long time, because the pattern he had seen in the Ashbourne ledgers that day was not entirely unfamiliar. It was quieter than the fraud he had helped unravel years ago, more carefully distributed, but it had the same architecture, the same way of building something that looked ordinary from the outside and was hollow at its core. The following morning, Nolan submitted a formal request through the company's document management system for the original signed contracts associated with Northbridge Advisory Services, Crestline Technical Partners, and Meridian Facility Solutions, specifying the request as routine pre-filing verification and routing it through the Accounts Payable Department, which was the correct procedural channel. Within 40 minutes, he received a calendar invitation instead of a document link. Barrett Kingsley's executive assistant requesting his presence in the CFO's conference suite at 2 o'clock that afternoon, no agenda attached. The conference suite on the executive floor was a room designed to make its visitors feel the weight of the institution behind it. Floor-to-ceiling windows facing south toward the lake, a table that could seat 20 made from a single slab of walnut, chairs upholstered in leather that cost more per yard than Nolan's monthly car payment. When he arrived, Victoria Ashbourne was already seated at the head of the table, Barrett Kingsley to her left and Miles Sterling to her right, and 3 tablets arranged in a neat row on the table surface. Each showed a slide from the presentation the executive team was preparing for the investment banks underwriting the Ashbourne Dynamics IPO. Nolan was the only person in the room not wearing something that had been custom-fitted, and Victoria acknowledged this by looking at his shirt collar before looking at his face, a small ranking that she did not bother to conceal, and Barrett said nothing because he had already said what needed saying by scheduling a meeting rather than producing the documents. Nolan explained, with the economy of language that characterized every professional exchange he had ever conducted, that several vendors currently recorded as service providers for the company's deductible consulting expenses appeared to share registration infrastructure and could not be verified as operational entities, and that if those expenses had been used to reduce the company's taxable income, the resulting discrepancy represented a material risk that would need to be disclosed or corrected before the tax filing was finalized. Victoria did not ask about the documents. She looked at the tablet in front of her, then back at Nolan, and asked whether he had ever personally managed a business that employed thousands of people across multiple states, whether he had ever sat across from a sovereign wealth fund and defended a revenue projection, whether he had ever been responsible for a payroll that ran 9 figures annually. Nolan said he had not, and he said that the accounting standards governing the deductibility of business expenses did not vary according to the complexity of the business incurring them, and that the relevant question was not about the size of the enterprise, but about whether the expenses being claimed had a corresponding service that had actually been performed. The room was quiet for a moment that lasted slightly too long to be comfortable. Then Victoria looked at Barrett and said, to no one in particular, that the company employed outside tax counsel and that any question about the firm's filing strategy should be directed to those advisors rather than flagged internally by someone whose function was limited to checking that numbers matched across columns. You verify invoices, she said, and the precision of her dismissal was delivered in the flat tone of someone who had practiced it until it stopped feeling like cruelty. That is your role. Do not mistake arithmetic for judgment. Miles nodded and said the firm's tax counsel had reviewed and signed off on everything, and Barrett offered to share the opinion letter once his team had pulled it from the archive. An offer made without producing any timeline or reference number for the document he was claiming existed. Nolan returned to his desk and found that his access to the financial records of 2 Ashbourne subsidiaries had been restricted by a permissions change processed while he was in the meeting. He stared at the access denied message on his screen for a long moment and understood something clearly. The resistance he had encountered was not the ordinary defensiveness of executives who disliked being questioned. It was the specific, targeted obstruction of people who had something to protect and who had decided, perhaps too quickly, that a man in a worn suit with a daughter to pick up could be stopped with a locked door. The research and development tax credits were the next thread Nolan pulled. Over the preceding 3 fiscal years, Ashbourne Industrial Group had claimed substantial credits under federal research activity provisions, supporting those claims with documentation of 5 internal innovation projects that together accounted for tens of millions of dollars in qualifying expenditures. The projects had names: Helix, Meridian Bridge, Compound 7, Atlas Framework, and Redline, and they appeared in the company's disclosures as active development initiatives being conducted by a team of engineers and research personnel at the company's Chicago and Rockford facilities. What they did not appear in was the building access logs, the equipment reservation systems, the supply chain records for research materials, or the payroll breakdown by project code that the facilities management team generated each quarter as a standard operational metric. Nolan pulled the personnel records for the Helix project, which, according to the tax filings, had employed 37 engineers on a full-time basis during a 14-month development cycle. Cross-referencing the listed employee numbers against the Human Resources Termination Database, a system he had access to as part of his standard tax accounting function. He identified 19 of those 37 individuals as employees whose separation from the company had been recorded before the project's stated start date. One name on the list belonged to a man whose death had been acknowledged in a company-wide memorial email sent more than a year before his salary had allegedly been allocated to the Helix project's research budget. Nolan wrote the name down carefully, set it apart from the other entries in his notes, and moved to the next project. He reached out to Dana Brooks in the internal audit division on a Thursday morning, walking to her office rather than sending a message through any system that might be monitored, telling her what he had found and framing it precisely, not as fraud, not as corruption, but as a set of discrepancies requiring explanation that had thus far received obstruction instead of documentation. Dana said she had flagged similar inconsistencies 18 months earlier, specifically around the vendor payment patterns in the research expenditure accounts, and had been told by Barrett Kingsley that those records were proprietary to a competitive strategy review and were not subject to routine audit scrutiny. She and Nolan agreed on a methodology that would keep their inquiry within the boundaries of what each of them was formally permitted to access: payroll data, facility logs, equipment maintenance records, materials procurement invoices, and project management system timestamps. And they began working through it systematically, Dana pulling reports from her department's archive, while Nolan mapped each data point against the tax filing's representations. What the data showed, when laid out in a sequence that could be explained to anyone without a forensic accounting background, was that 3 of the 5 projects had almost no operational footprint: no laboratory time logged, no reagent purchases, no engineering software licenses activated under their budget codes, no milestone documentation in the project management system, nothing that would indicate dozens of engineers had spent months working on anything at all. Miles Sterling appeared not only in the vendor communications but in a separate context. 4 days after a quarterly close, he had sent an internal email to members of the facilities team instructing them to reclassify a set of vendor payments from administrative management fees to a new category called technical development services, a reclassification that made the payments eligible for research credit treatment they had not originally qualified for, delivered under a subject line that read year-end cost code alignment, and a tone that implied routine bookkeeping. When Nolan read it, he recognized the architecture of something he had seen in a different company, in a different city, many years before. That same week, at a dinner the executive team held for a group of regional banking partners, Miles arranged for Nolan to attend as a supporting member of the finance division, and at one point in the evening, in front of the bank representatives and a cluster of senior managers, Miles turned to Nolan mid-conversation and said that if anyone at the table had questions about the basics of tax expense allocation, the company's entry-level accounting staff would be happy to explain it in simple terms, then asked the server, loudly enough for the table to hear, whether there was anything on the menu in Nolan's price range. There was laughter. Nolan put his fork down and said nothing, because he had learned a long time ago that the people who needed to perform contempt the loudest were usually the ones with the most to conceal, and that silence in those moments was not weakness, it was patience wearing a suit. Dana found the version history on a Tuesday afternoon, buried in the backup archive of the company's financial consolidation system, a platform that automatically preserved prior versions of any document modified after initial submission. The tax summary worksheet that Nolan had originally prepared showed a corporate tax liability figure substantially higher than the number appearing in the version that had been submitted for final review, and the modification had been made under the username of a junior analyst who had resigned from the company 11 weeks before the change was recorded. Using a session that had been initiated from a workstation registered to Barrett Kingsley's private office on the executive floor, the timestamp showing the change had been made at 11:47 in the evening, on a night when building security logs confirmed no junior analyst had badged in. Nolan and Dana documented everything they had: the vendor cross-references, the personnel discrepancies in the research filings, the cost code reclassification email, the modified worksheet and its session metadata, and Nolan prepared a preliminary findings memo addressed to Barrett Kingsley, Victoria Ashbourne, and the company's general counsel. The memo was not written as an accusation. It was written as a set of questions, each one supported by a document reference, requesting that the company suspend finalization of its tax submission until an independent review could be completed. He sent it through the company's formal document management system at 9 in the morning and received a phone call from Barrett's private line before noon. Barrett spoke carefully, which was a different register than his usual boardroom confidence, and he said there were opportunities within the company for people who understood the complexity of large-scale tax strategy. Opportunities that came with titles and compensation packages significantly above Nolan's current level, and that those opportunities had a tendency to open up when the right moment arrived, and when the right people understood when to let certain matters resolve themselves through channels better suited to handle them. Nolan said he appreciated the call and declined. Barrett's tone changed, and he said the company had a record of how Nolan managed his time, that a pattern of leaving before 6, skipping leadership events, and being unavailable for after-hours strategic planning created a perception issue that the human resources team had documented and that could become relevant in any performance-related review. The implication was clear. The choice Nolan had made to be a present father could be reconstructed as a professional liability if the right people chose to frame it that way. Nolan did not respond to that. He returned to the document he had been reviewing, made 3 additional notes in the margin of his tracking spreadsheet, and when Victoria subsequently convened a session of the senior leadership team and held up his preliminary memo, calling it a document produced by someone who had confused caution with capability. Nolan waited until she finished and then pointed to the signature page at the back of the filing package. Not his own signature, but Victoria Ashbourne's electronic approval, appended to the exact representations he was questioning. She had approved the document. Her name was on it. She said she had signed on the advice of her CFO and outside counsel, and Nolan said that relying on advisors could explain a mistake made in good faith, but that a chief executive officer who received a written warning about specific discrepancies, documentation provided, timeline attached, source references listed, and then directed her team to finalize and submit the filing anyway, was no longer operating in the same category as an unknowing signatory. For the first time in any meeting Nolan had attended at Ashbourne Industrial Group, the smile left Victoria Ashbourne's face, and it did not come back. The campaign to remove Nolan moved quickly, once Barrett decided that waiting was more dangerous than acting. The formal complaint, filed through Human Resources, ran to 4 pages and included 5 allegations: that Nolan had accessed data systems outside his authorized scope, that he had caused disruption in the finance department through unauthorized inquiries, that he had deliberately interfered with a material corporate transaction, that he had failed to comply with directives from senior leadership, and that he had manufactured a crisis in order to elevate his own standing within the organization. Victoria called a meeting with the full senior leadership team and spoke for several minutes about the difference between an accountant who understood his role and one who confused his function with authority. She referenced Nolan's departure from his previous employer in a way that implied failure rather than choice, and she mentioned, in a tone calibrated to land without seeming deliberate, that a member of the finance team who required schedule accommodations for family responsibilities was not in a position to lecture the executive floor on what accountability looked like. Nolan sat through it without expression, and when Victoria finished, he asked that a single question be entered into the meeting minutes before any further action was recorded. Specifically, why 3 vendors that had collectively received over $8 million in payments from Ashbourne operating accounts shared an incorporation address belonging to a relative of the company's chief financial officer. The room did not go loud. It went quiet in the specific way that happens when a fact arrives in a space where it cannot be pretended away. Barrett said it was a coincidence that the shared address was a registered agent service used by many entities and meant nothing on its own. Victoria announced that Nolan's system access would be suspended pending review of the complaint and that building security would accompany him from the premises. Nolan stood, straightened his jacket, and placed a sealed envelope on the table. He told the room that prior to the meeting, he had transmitted a copy of his preliminary findings to Evelyn Hartwell, chair of the Audit Committee of the Board of Directors, through the company's formal whistleblower disclosure channel, in compliance with Article 9 of Ashbourne Industrial Group's own corporate governance policy. The envelope, he said, was an acknowledgement receipt from the governance office. Victoria looked at the envelope and understood, in the way that very intelligent people understand things the moment before they admit it, that removing Nolan from the building had not removed his findings from the hands of the one person on the board she could not control. She had believed, until that moment, that the influence carried by 3 generations of the Ashbourne name was enough to manage a board committee. She was about to discover exactly how much she had miscalculated the woman sitting in that committee's chair. Evelyn Hartwell read Nolan's disclosure memo at her kitchen table that evening with the focus she had developed over 2 decades on the federal bench. The habit of separating what was claimed from what was documented and never allowing the emotional register of a document to substitute for the evidentiary weight of its contents. The memo did not claim $40 million in fraud. It presented a set of discrepancies, assigned confidence levels to each one, identified what additional documentation would be needed to resolve the uncertain ones, and listed the specific questions that had received obstruction rather than answers. What Evelyn noticed, and what she later told the Audit Committee, was that whoever had prepared the document had been extremely careful not to assert anything they could not support, which was a more significant indicator of integrity than the specific findings themselves, because a person constructing a false narrative inflates their claims, while a person conducting a genuine inquiry marks their uncertainty. She convened an emergency session of the Audit Committee without notifying Victoria or Barrett, contacting each board member directly through personal channels to avoid any communication platform accessible to the executive team. Dana Brooks confirmed to the committee by telephone that Nolan's inquiry had been conducted entirely within the scope of his authorized system access, and that every data point in his memo could be reproduced from documents residing in the company's own archive. The committee issued 5 directives that evening. Nolan's access would be restored under Audit Committee supervision. A forensic accounting firm with no prior relationship to Ashbourne would be engaged and would report directly to the board. A litigation hold would be placed on all email, financial records, and document management history. Executive access to the tax filing systems would be frozen, and independent legal counsel retained by the board, not the company, would be available to any employee with relevant information who wished to provide it without fear of retaliation. When Nolan returned to the Ashbourne building 2 days later, it was not to his old desk. He was given a workspace in a conference room reserved for the Audit Committee's use and asked to lead the analytical team supporting the forensic firm's independent review. The forensic accountants began where Nolan's memo ended and moved outward from there, pulling records through court-authorized channels that no internal permissions change could obstruct. Northbridge Advisory Services, Crestline Technical Partners, and Meridian Facility Solutions were confirmed to have no employees, no operating accounts, no service records, and no clients other than Ashbourne, and the money they had received had passed through a series of intermediary accounts. 3 in Delaware, 1 in Nevada, 1 held at a small bank whose financial ownership records, when subpoenaed, included Barrett Kingsley's name as a principal. A junior assistant in the finance department came forward voluntarily and produced a series of emails in which Barrett had asked her to adjust submission dates on a batch of invoices so that the associated deductions would fall within a prior fiscal year's return, a request delivered through a messaging channel not included in the company's initial document retention scope. Most significantly, The forensic team located the email thread that had preceded Victoria Ashbourne's signature on the filing package, a thread in which Nolan's concerns had been summarized and transmitted to her office, and in which her reply, sent from her personal corporate address at 6:22 in the morning on a Thursday, had read, "Finalize the numbers. This transaction matters more than one accountant's caution." The thread carried a timestamp 14 days before the quarterly filing was submitted. Victoria had not been uninformed. She had been informed, and she had given an instruction. The consolidated findings report ran to over 300 pages and was presented to the full audit committee in a session that Nolan led from the front of the room, standing without notes, walking through the methodology section by section with the same deliberateness he applied to everything that carried his name. He organized the findings into 3 tiers: amounts that were definitively improper, amounts that were highly probable but required regulatory confirmation, and amounts that remained uncertain pending third-party verification. And he was specific about the boundaries of each category, never allowing the definitive tier to absorb the uncertain one simply because the combined total was more dramatic. The bottom line, restricted to the definitively and highly probable improper amounts, came to slightly more than $40 million when projected penalties and interest accruals were included. $17 million in deductions from phantom consulting and service invoices, $11 million in research credits based on projects that had almost no verifiable operational activity, $8 million in payroll and compensation obligations that had been misclassified to create additional deduction opportunities, and $4 million in penalties, interest, and supplemental obligations that arose as a direct consequence of the underlying filing errors. Barrett Kingsley had engaged his own legal team and submitted a written statement alleging that Nolan had pursued the investigation as a form of personal retaliation, citing an unsuccessful application 2 years earlier for a director-level position that had been filled by an external candidate. Nolan confirmed the application was accurate and noted that it had been submitted 26 months before the current investigation began, that it had been for a role in a different division, and that he had never filed a complaint about the outcome. The statement also asserted that Nolan was leveraging a prior professional background to manufacture the appearance of systemic fraud where only technical filing errors existed. It was at this point that Evelyn Hartwell asked Barrett's counsel to clarify exactly what prior background was being referenced. The answer required someone else at the table to speak, because Nolan himself had never discussed it at Ashbourne. Before joining the company 4 years earlier, he had spent 11 years at a national forensic accounting firm, the last 4 as a senior investigative lead. His team had been responsible for uncovering a complex multi-entity tax scheme that had generated over $100 million in improper deductions across an 8-year period, and the recovery from that case had been distributed to the investors and pension funds that had been affected. He had left that position not because of any professional failing, but because his wife had been diagnosed with a degenerative illness that required daily care that could not be delegated, and he had chosen a position with predictable hours over a role that would have meant her spending those years in someone else's presence instead of his. Victoria Ashbourne had spent several months mocking the choices a man had made to be available to his family, and now she was learning that those choices had been made from a position of professional capability she had never taken the trouble to assess. Nolan signed the final report as lead investigator, special review team, and the confirmed total was displayed on the screen at the front of the boardroom. $40,218,600 in tax liability, penalties, and interest projected. No one in the room called it an invoice. The full board of directors convened a formal governance session with Victoria, Barrett, and Miles, present alongside their respective legal representatives. Victoria arrived with a team of 5 attorneys and maintained through the first 40 minutes the composure of someone who had spent her life in rooms where composure was currency and who still believed it was worth something here. Barrett had prepared a narrative that positioned Miles as the operational decision-maker, and Miles had prepared a narrative that positioned everything he had done as consistent with direction received from the CFO and the CEO, and the two narratives collapsed against each other almost immediately because they could not both be true simultaneously, and the documents made clear that neither was entirely true independently. Nolan did not argue with any of them. He presented the evidence in the order it had occurred, chronologically, without characterization. Vendors incorporated, contracts executed, deductions claimed, data altered, warning issued, warning overridden, warning suppressed, investigation initiated, access blocked, whistleblower removed from the building. And when he reached the email bearing Victoria's reply, he let the screen hold it for a moment before continuing. She said she had trusted the people she had authorized to manage the process. He said the record showed that after receiving a specific written warning, she had not asked for an investigation. She had asked for silence. Barrett turned toward Miles and began to assign responsibility, and Miles immediately said that every action he had taken had been explicitly approved at the CFO and CEO level, and the room understood that whatever the order of legal exposure might ultimately be, the chain of authorization ran in one direction only. Evelyn Hartwell announced that the board would recommend voluntary amendment of the company's tax filings for the 3 affected years and would authorize full cooperation with any regulatory inquiry, a decision made in the interest of the company's employees and shareholders rather than its current leadership. The vote was taken. Barrett Kingsley was terminated immediately and his matter referred to the appropriate federal authorities. Miles Sterling was dismissed for submitting false operational certifications. Victoria Ashbourne was removed from the chief executive role, effective immediately, pending the conclusion of a personal liability assessment by independent counsel. Nolan did not speak after the vote. He gathered his documents, stacked them in order, and placed them in his briefcase with the care of someone who understood that what happened in that room would take years to fully resolve, and that the resolution was not the end. It was the beginning of the work of repair. Several weeks after the board's decision, the formal governance process required a final internal disclosure hearing, and Victoria Ashbourne entered that room from the door opposite the one she had always used. The seat she was assigned was not at the head of the table. It was at the side, facing the panel, the position that Nolan had occupied the morning. She told the executive team he was nothing more than a man who checked columns for a living. She asked him, without preamble, whether he felt any satisfaction in having dismantled the legacy 3 generations of her family had constructed. Nolan thought about it for a moment before answering, because the question deserved a real answer rather than a performative one, and he said he had not dismantled anything. The Ashbourne name had existed for decades before the current leadership arrived, and would continue to mean something after it, provided the institution carrying that name was willing to be honest about what had happened and to build its next chapter on something other than numbers shaped to serve the people counting them, rather than the people counting on them. He said that a company which corrected its own records voluntarily would cost its shareholders less than a company corrected from the outside, and that the difference between those two outcomes had been entirely within the control of the people who had chosen obstruction over accountability. Victoria told him he had no understanding of what it cost to lead at the level she had operated. Nolan said he understood that leadership was not measured by the number of people required to follow through instructions, but by the number of people who would bear the consequences of the decisions being made, and that a choice to finalize a fraudulent filing was not ultimately a decision about tax strategy. It was a decision about how many employees, pension contributors, and ordinary investors would eventually absorb the damage when the strategy collapsed, as strategies built on false documents always, without exception, eventually did. The board formally confirmed Victoria Ashbourne's removal before the hearing concluded. She stood to leave, and she looked at the jacket Nolan was wearing, the same charcoal suit she had assessed on the day she decided he was too small to matter. And she asked why, now that he was the most consequential figure in the entire investigation, he had not bought something new to wear. Nolan told her the suit had never been the issue. The issue was that some people had decided the worth of a human being could be determined by looking at what they wore on the way into a room, and those same people had not looked closely enough at what the person did once they arrived. 6 months after the board's formal action, Ashbourne Industrial Group completed its voluntary restatement of 3 years of federal tax filings and reached a comprehensive settlement with the relevant authorities. The terms required the company to pay the full assessed liability, establish an independent compliance monitoring program, and submit to periodic reviews for a period of 5 years. The process was costly, but the company remained solvent, in large part because the board had moved quickly and voluntarily, a distinction that the regulators acknowledged in their public statement, and that Evelyn Hartwell later described as the single most important factor in preventing the investigation from becoming an existential event for the company's 12,000 employees. The board offered Nolan the position of Chief Financial Officer. He declined, telling Evelyn that he did not think a role should be offered as a reward for a crisis, or accepted in the emotional climate that follows one, and that accepting a title he had not been appointed to before the investigation would make it impossible for anyone to know whether he had earned it or been given it. He accepted instead the position of Director of Integrity and Independent Audit, reporting directly to the Audit Committee of the board rather than to any member of the executive team. In that role, he developed a set of institutional policies that the company adopted as binding governance requirements, formal protections for employees who raised financial concerns through any channel, mandatory independent verification of all vendor relationships involving any person connected to company leadership within 2 degrees, a compensation structure for senior officers that excluded short-term earnings as a primary metric, a policy prohibiting adverse employment actions based on schedule accommodations for caregiver responsibilities, and a requirement that all material tax positions be reviewed by an external advisor with no prior relationship to the company's management team before submission. Dana Brooks was appointed to lead the internal audit function as its new director, the position she had effectively been doing the work of for years without the authority to act on what she found. On the morning the company held its formal announcement of the restructured governance program, Nolan arrived the way he always had, parking the sedan in the employee lot, carrying the lunchbox, moving through the lobby with the same unhurried pace the security desk had seen 4 days a week for 4 years. Sadie had attended the morning event, standing near the back of the room while the board chair spoke, and afterward she asked her father whether he ever regretted stepping back from the career he had walked away from when her mother became ill. Nolan told her he had not walked away from anything. He had made a choice at a moment when one of the people he was responsible for needed him to be present, and the value of a person's professional life was not determined by the trajectory it followed in the years when everything was easy, but by the quality of the judgment they brought to the moments when the right path was also the harder one. Sadie nodded, and they drove home through the same streets they always drove, the city moving around them the way it always had, indifferent and enormous, full of buildings that carried names and people inside those buildings quietly deciding, every day, which of those names deserved to mean something. Weeks later, on an ordinary morning in the office that had once belonged to a different kind of executive, a young analyst knocked on the open door and stepped inside, holding a quarterly expense report, and looking the specific kind of careful that people look when they have found something they did not want to find, and are not certain they will be believed. She told Nolan she had noticed a vendor pattern that did not match the operational data, and that she did not know if she was right to question it or if she would be in trouble for bringing it up. Nolan pulled a chair out from the small table near the window and told her to sit down, and he said the thing he had decided, in those months of building something out of what had been broken, was the most important policy a company could hold. That the person who found the problem would never, in this building, be treated as the problem. The morning light fell across the old charcoal suit hanging behind the office door, its worn lapels unchanged, its quiet presence a reminder that the man who had walked into this building 4 years ago with a dented lunchbox and a broken briefcase clasp had not been too small to see what was wrong. He had only been waiting, with the patience of someone who understood that phantom invoices do not disappear when powerful people refuse to look at them. For the moment when the people willing to look were finally the ones in the room.